All right, let's continue on with our adjusting entries. We're on deferrals. So we're ready for prepaid expenses. Expenses that have been paid but not yet incurred. So looking at an example, we have September 1st, NewCo, a calendar year company, purchases a 1-year insurance policy for $600. So this will go from September 1 of this year until September 1 of the following year. So that we're going to have an overlap. We need to know what will happen on December 31st because the business has a year end that is calendar year end December 31st. A 1-year insurance policy for $600 can be recorded in two ways. We can set this up as a prepaid insurance account, that's an asset of $600 and a credit to cash, or we can record it directly to insurance expense for $600 and a credit to cash. Now, keep in mind this overlaps 2 fiscal years, which are calendar years. We're going to need to take the 600 and divide by 12 so that we have $50 a month of insurance. And we're looking at, this should be like December 31st is what this should say. It says, what should the December 30th, well, that's December 31st balance be in prepaid insurance and in insurance expense. Because we want to have those two accounts reflect the expense and what should be showing in prepaid insurance to carry forward to the next year. So looking at this, we've got 9/1, September 1st through December 31st, and that's September, October, November, December. That's 4 months in the current calendar year, leaving out of 12 months total. That will leave 8 months for the following year. So now we've got this at $50 a month. They're saying 4 months, 4 out of 12, 4/12 or 1/3 has been used up, and that leaves the 8 months or 8/12, 2/3 unused. So looking at this, we've got the two buddy accounts, insurance expense and prepaid insurance. Since we're looking at insurance expense from September 1 through December 31st, that's $50 times 4, that's $200 for expense in the current year. And that leaves out of the total of 600 less 200, that's 400 in prepaid insurance for the 8 months in the following year. 8 months times 50 is $400. But together, the two add up to be 600. All right, so if it's initially recorded as prepaid insurance, the $600 is set up in prepaid insurance. Well, we actually have used $200, so we need to credit $200 to prepaid insurance and debit it to insurance expense to have the account balances correctly reflect what they should have at year end. So there's the journal entry that needs to be made. If it's initially recorded as insurance expense, then you've got $600 in insurance expense, but at December 31st, you want to have just $200. So that means we're going to need to credit insurance expense for the $400, transfer it over to prepaid insurance so that we've got 8 months worth of insurance to carry forward in the new year. There's the entry that should be made. Now, the adjusting entry that is made depends upon how the $600 payment was initially recorded. Keep in mind that you could set it up and debit an expense credit prepaid expense, or you could debit a prepaid expense and credit whatever the expense is. So the first one is the adjusting entry if the payment was recorded as an asset account, because it's transferring out what has been used by crediting it. The second alternative shown is the adjusting entry if the payment was recorded as an expense account. And you're transferring out of expense what has not been used and what will carry forward to the next fiscal year. This adjusting entry that we're looking at here reduces net income when you debit expense, and it reduces assets. On the right side here, this adjusting entry increases assets and it increases net income. What happens to the financial statements if the adjusting entry is not recorded? Well, over here, the adjusting entry that increases expenses, without it, net income is going to be overstated. It also reduces assets, and so without it, assets will be overstated. The second alternative, this one increases assets, without it, assets will be understated. This one reduces expenses, without it, net income will be understated. So we've got to be able to think about the effect not recording the necessary adjusting entry will have. Here's a recap of the basic adjustments. We have the two accruals, the accrued expense, the accrued revenue, and we have the two deferrals, the prepaid expense and the deferred revenue. This summarizes the various adjusting entries that need to be made and the impact that they have if the adjusting entry is not made. So I'm not going to restate this. I'm just simply going to click on them, and as you go through you can take a look and see. This is something you might want to print off and have as a reference. Alright, in addition to the adjusting entries needed for routine accruals and deferrals, there are other end-of-period adjusting entries that need to be made. One of them includes the depreciation expense, the other the bad debt expense. So we need to take a look at these. The depreciation expense, to recognize depreciation for the period, we need to debit depreciation expense, credit accumulated depreciation. This entry is one that increases expenses. It also reduces assets because the accumulated depreciation, which is a contra asset account, will reduce assets. It shows with the assets. The accumulated depreciation is paired with a fixed asset account and therefore reduces the net book value, the net assets. Straight line depreciation expense, if you can remember from a previous accounting class, the basic formula is where we take the cost less its residual value or salvage value, and we divide it by the estimated useful life in years. And that will give us the annual depreciation expense. Here we have Patco. It purchases for its business equipment. It purchases business equipment that costs $25,000. Patco estimates that the equipment will have a useful life of 6 years, and at the end of the life will have a residual value of $1,000. So what we're going to do is we're going to substitute into this formula these amounts that we're given. The cost, $25,000, residual, $1,000, and the estimated useful life in years, 6 years. So we have $25,000 less $1,000 will give us a depreciable cost of $24,000, and when you divide that by 6, that will give you $4,000 in annual depreciation. So each year, if this is purchased at the beginning, in the first month of a calendar or fiscal year, each year there will be $4,000 in depreciation expense. So Patco will debit depreciation expense, credit accumulated depreciation in the amount of $4,000. To take a look at the accounts, equipment has $25,000. Accumulated depreciation at the end of year 1 will have a credit of $4,000, year 2 another 4, year 3 another 4, so that we're looking at each year $4,000. Well, they've gone through 3 years here. There would be accumulated depreciation balance of $12,000, and the book value then that would be reported at the end of year 3 would be the equipment at cost $25,000 less the accumulated depreciation of $12,000, and it would leave a net book value for the equipment of $13,000. Bad debt expense. Well, the matching principle requires an attempt to match costs with the revenues that the costs help produce. So matching is simply saying that expenses need to be recorded in the period in which the revenue that they've helped earn. So one application of the matching principle is when it comes to bad debt. It requires that companies estimate bad debt, come up with an estimation of what the cost of the bad debt will be for that fiscal year, and match that bad debt to its related non-cash sales or revenue. The entry to record bad debt expense is a debit to bad debt expense and a credit to allowance for doubtful accounts. Here again we have some other account names that we can use. Bad debt expense could be called doubtful account expense. It could be called uncollectible account expense. The allowance account could be allowance for bad debts, allowance for the doubtful accounts that you see there, allowance for uncollectible accounts. The allowance for doubtful accounts is a contra asset account that is paired with accounts receivable. So that this entry, this credit to allowance for doubtful accounts, is going to be subtracted from accounts receivable to arrive at the net realizable accounts receivable. So here we have an example of accounts receivable $35,000 less allowance for doubtful accounts of $4,200, and that gives us a net realizable value of $30,800.